Despite today's rally, our next guest says there is limited upside left for this bull run. Let's bring in Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. What are you worried about, Mike?
Well, I'm not really worried. I'm not hand-wringing over this, but you mentioned the right thing, Karen. The rates now are at 310, okay? That was not the case, 6 months ago, and so that does put valuation constraint. We think 16.5 times is kind of it. That's about as high as you can go when rates are at 310. That would be slightly below where we're trading today on a forward 12-month basis in terms of where earnings are, 173. The difference between now and a year ago is that a year ago we still had tax to look forward to. We still had a lot of this leverage in the earnings model to look forward to. Today we don't. So if we're at 173 on a forward 12-month basis, next year's 178, we think 178 is too high already. That means so 175 is kind of your number. You don't have the earnings upside you do over the next 12 months. So what are we playing for at this point? You're just kind of moving the chairs around. Yeah, you can rotate around, but what's really interesting to me is the internals have been lousy, right, Guy? But I mean, that's because the market's confused. It's looking for new leadership here. I do like healthcare. Healthcare has the sort of, both the growth properties and some of the defensive properties that we've been favoring this year, so you can find some names in there. Even within tech, there's still good names. It's just not as broad. Okay, the banks are probably the one thing that worries me the most, to be honest. You asked what worries me? The way the banks trade is telling me that growth is going to be even worse next year than what we're forecasting.
You mentioned the valuation of the overall market is pretty full right now. When you take a look at a sector like, let's say, healthcare is almost in line with the broader markets at this point. So how do you view valuations when you're looking at the sectors that you like?
Yeah, so healthcare is probably the most diverse sector out there. I mean, you have value stocks and growth stocks. You're in the gamut. So on average, yeah, it's about average because it looks like the market in many ways. So I don't think healthcare is nearly as cheap as it was. Some of these issues around drug pricing, those concerns have taken a back seat, and that's really helped healthcare here in the short term. But it's a stock picking game. At least you can find names within healthcare that can grow, okay? And they're somewhat defensive because I am worried a little bit about the deceleration that we're going to see next year, both economically and from an earnings growth standpoint.
Mike, what are you doing with energy, especially oil prices, which at this point, even just technically, they're at an average price now that people have to be pushing up estimates for a lot of the big integrateds?
We like energy a lot. That's been our favorite sector for most of this year because it has defensive properties. That sounds kind of weird. It's a cyclical group, but it has defensive properties because of some of those yields.
Yep.
We're going to get big revisions in the October reporting season because the earnings move or the oil price move has been dramatic, and that's not baked into the numbers. So on a relative earnings revision basis over the next 4 weeks, I think energy's got to be in the portfolio.
Mike, so what we see going into year end is a chase for performance, and with the average hedge fund somewhere around up 3%, where do you see the chase for performance coming in to your premise?
Well, look, you mentioned the three sectors that have really outperformed this year: tech, consumer discretionary, and healthcare. Those are going to get a bid because that's what people own, right? So people like to chase kind of what they own. They're comfortable with the names. But I do think this rotation towards defensively oriented sectors has happened since June. We're going to see more of that as well. So in other words, you're going to get chasing in areas that people don't own because they're going to work. But I think what they're going to want to buy are the things that have worked all year. And that's typically what most active managers do. They chase the things that have been working this year until they stop. Now, I mentioned earlier that the breadth of the technology sector has been pretty weak over the last 4 to 5, 6 weeks. I think we're going to see more names kind of fall off in October. And I think that's what portfolio managers should be really focused on right now. Make sure that what you do have in the portfolio today is something you feel very good about going through earnings season with.
You mentioned the 10-year yield at 3.10s or thereabouts at this point. Are you worried about inflation in and of itself, or are you only worried about the yield in relationship to the valuation of stocks?
Well, it depends on what kind of inflation we're getting, right? So, good inflation, meaning costs are going up to offset some of these increases in input costs, is healthy. That's a bull market. But what I am worried about is energy costs. That's not healthy, generally. Energy, things that can disrupt the consumer, prices that can't be passed on necessarily in the supply chain, freight costs, tariffs. I mean, I don't think by the way, I don't think tariffs is resolved because we got this deal with Mexico and Canada. The big one's always been about China. So I think that's going to come back into play after the midterms, and I think that is the biggest risk for next year is tariffs and margins. We think even without tariffs going up next year, that margins is going to be the story in 2019 that's disappointing. That's where the biggest risk is on earnings.
Quickly, you mentioned China. How is the market underestimating the resolve of the Chinese?
Well, look, the Chinese can play long ball, right? I mean, I think they can take a lot of pain. I think there's no incentive for the Chinese, in my view, to negotiate now, right? Let's wait and see what happens with the election, see how tough the president wants to be post the midterm, see how it turns out, right? I think the Chinese probably quietly are hoping for a correction in the stock market, quite frankly, because maybe that will get the administration to kind of come to the table a bit more. Look, I think that President Trump has shown a penchant to want to go the distance on this. And I think it's, it's going to get scary again. Let's put it that way. I don't know where it ends up, but I think it's going to get scary again. And right now, it doesn't seem that scary from an investor perspective at the moment.
Mike, thank you. Good to see you. Mike
You too.
Wilson of Morgan Stanley. Karen, are you with Mike in terms of limited upside here?
Well, I think his job is to sort of make market calls,
Right.
which I feel like is the opposite of my job. It scares me a little when he talks about the multiple, whatever. I do think the markets they don't stop on a dime of valuation of here's the correct valuation. They go too far one way or another, and I'm suspecting we will go too far to the upside.
So just, I brought up energy because I really love the integrateds here. And if you read a lot of the good reports out there, you can see that valuations on a price to free cash flow relative to their history, people like Chevron, Royal Dutch are very, very cheap. I think this is a place you can continue to play. And I like the yield basis as well, even though people think yields are going higher.
Mike was worried about growth sort of being pulled forward or growth out of the picture, or it's going to be less than what it is now. Then that means that the Fed should probably sit back. He was also worried about interest rates. So maybe the Fed sits back if growth isn't as great and rates come in a little bit, and maybe that salvages the rally.
Sits back
that we're
when, in
saying.
2019?
Well, we're seeing it right now. He's worried about it right now. So.
Okay, quick.
I still think the Fed is going to, I still think the Fed moves at least 3 times next year, but that's what makes markets. And again, going back to the original conversation, I think there's still some runway in healthcare. Maybe it is starting to get a little expensive, but I think there'll be catch up into the end of the year in the healthcare sector.